If you had invested $1 exactly 5 years ago into Shopify, you would have made $37, outpacing even the greatest American stocks like Square, Tesla, Nvidia, Apple, and Amazon. However, there's actually one much more underrated Canadian company that has started building a small empire through the acquisition of over 30 companies, and whose 5-year growth has even surpassed Shopify. That company is WELL Health Technologies, whose stock price grew by an astounding 5,600% within the same time frame. With a market cap of $1.5 billion, a forward price to earnings ratio of 122, price to sales of 22.8, and losses going back 5 years, this is obviously just another overvalued and overhyped penny stock, right? Well, not so fast. Even after this phenomenal run, analysts all seem to agree that their revenues are projected to grow by 430% in 2021 and 60% in 2022, and by taking their current market cap of $1.49 billion and dividing by their forward 2022 sales estimate of $423 million, we can calculate that their forward price to sales ratio is expected to be 3.5. This makes their valuation pretty attractive, especially considering that WELL and its peers in the digital healthcare industry are currently trading today at these much higher multiples. In fact, at WELL's discounted price of $7.3 today, analysts believe that they should be valued anywhere from $10 to $13. This represents on average an above 50% potential upside, which many investors actually believe is conservative given their future growth potential. But how is this insane growth even possible, and is this growth just the beginning? Before answering those two questions, we must first look into the company's history and assess whether they can replicate their performance going forward. Our story begins in 2016. A group of seasoned entrepreneurs from various backgrounds get together with $327,994 to form Movari Capital, a capital pool company. A capital pool company is a publicly listed company with an experienced management team whose goal is to acquire a private company and bring it public while providing them with their expertise. Movari Capital is led by Alex Red, a successful entrepreneur, co-author, and franchise partner to a long list of successful companies. His team is composed of many other experienced members, but the most important is a director named Hamed Shabazi, the founder and CEO of Tio Networks, a payment processing company which would later be sold to PayPal in 2018 for over $300 million. The initial mission of Movari Capital is to create a wellness platform that could support healthy aging and living. So on March 23, 2016, Movari Capital makes their first acquisition into Shakti Activewear, an online yoga and fitness clothing retailer. This brings their annualized revenue per share to 3 cents, their stock price to 15 cents, and by multiplying their stock price by 12 million outstanding shares, this brings their market cap to $1.8 million, which is our starting point. In June 2017, Movari Capital merges with Canada Yoga Inc., which owns a Chopra Yoga Center, by issuing out 28 million shares, and they change their name to Wellness Lifestyles, or WELL for short. These two acquisitions turn out to be really bad. By October 2017, WELL's revenue per share drops to 1 cent due to sales decline, high amounts of debt, which brings them to a negative equity position, and their auditors are forced to include an emphasis of matter on a going concern disclosure, which basically means that they're headed for bankruptcy unless something changes. Things were not looking good. However, their saving grace came as a vision of solving one of the most difficult problems that we Canadians have all personally struggled with at some point in our lives. That problem is the Canadian healthcare system. Let me know if any of this sounds familiar to you. You wake up one morning discovering you have a medical issue, and you call the clinic but learn that you have to wait 2 months just to see a doctor. When the day finally arrives, you have to take half a day off of work, drive to the clinic, which in itself is a whole issue if you live in a medically underserved area, wait for hours in a waiting room around other potentially sick people, just to find an overworked doctor who spends the first 15 minutes asking about your background and medical history. After all this, you get an illegible handwritten note to go to the pharmacy or to get referred to a specialist, and have to repeat the process all over again. Meanwhile, there is confusion about whether Canada has too many or too few doctors. With a waitlist that long, how could there possibly be too many? As it turns out, this issue is the result of lack of central planning, where geographically, some areas will have too many doctors and others will have too few. Now, instead of this broken system, imagine if the entire healthcare system was organized into a digitally unified platform where all health practitioners, from your local physician to pharmacists, therapists, dentists, etc., could communicate and collaborate seamlessly onto a single digitally integrated platform that could be quickly and easily accessed by all Canadians through an electronic device regardless of geographical location. Imagine, instead of waiting 2 months for a doctor, if you could just open an app and talk to a doctor in just 15 minutes, and they would then refer you directly to a pharmacist or specialist with a list of open time slots by location nearest to you for a direct appointment. How could we achieve this? The key is that we would have to convert every clinic's paper format documentation into an electronic medical record system, or EMR. Once converted, this data could be leveraged by layering additional services on top. Examples include telehealth, since doctors could now quickly access the patient's medical records, medical history, and provide virtual prescriptions. Billing software, since fees could now automatically be calculated for each treatment as they are entered into the EMR, which would save doctors from smaller clinics, especially time from administrative work. Digital health apps. Did you know that there are over 7,000 identified rare diseases worldwide? Since it's nearly impossible for any single physician to know every single rare disease, imagine a data analytics tool that can quickly scan through every patient record to quickly identify high-risk patients who may have been misdiagnosed. This app is called Cure and is currently being built on top of the Oscar EMR, which is the one that WELL currently uses. This is just a single example of an app created by an external collaborator that WELL ended up partnering with out of 27 digital apps currently. A fourth example is cybersecurity services. Since this platform now holds the most valuable data in the world, it needs to be protected, right? This is exactly what WELL eventually worked on. But let's go back to our story in 2017. Early investors get really excited about this idea, and the company manages to raise financing at 30 cents per share, which is double their initial share price, which has now grown to 47 cents per share. To further capitalize on this trend, WELL completely discontinues their yoga line, and they changed their name to WELL Health, then WELL Health Technologies in 2018. Hamed Shahbazi replaces Alex Red as the new CEO, and as stated before, Hamed Shahbazi sells his tech company Teo Networks to PayPal and brings in his whole team to work for WELL, and what happens in the next 3 years is nothing short of incredible. In 2018, WELL acquires 19 clinics, which increases their revenue per share to 34 cents. Then, in 2019, WELL acquires 4 different EMR providers and 2 additional clinics. These acquisitions don't actually increase their revenue per share, but overall, the acquisitions are still seen as a good thing because WELL benefits from network effects, which means that the more clinics and EMRs they acquire, the more they benefit from economies of scale for each subsequent vertical software acquisition. As a result, investors continue rushing into the stock, and WELL manages to raise financing at 46 cents, 95 cents, and $1.45. By December 31st, 2019, their stock price increases to $1.56, which is 3x from the year before. Then in 2020, the perfect storm hits the digital health industry as a pandemic sweeps over the world, reaching the top headline across every major news outlet. In the next year and a half, WELL raises over $400 million from investors and makes over 20 acquisitions into even more clinics, EMRs, digital health apps, cybersecurity, billing software, and CRH Medical, which is a significant anesthesia company in the United States. On February 8, 2021, their share price peaks at $9.80 before falling back down and consolidating around the $7 to $8 range. Their revenue run rate per share also increases to $1.80, and WELL is now the largest owner-operator of clinics in Canada. They have recently been included in the S&P TSX index and are positioned for a US uplisting on the Nasdaq in Q4 2021.